So I'm going to introduce our panel. I'll bring you gentlemen up. So we have Keith Banbury, COO of iwoca. We've got Jeff Lynn, co-founder and CEO of Seedrs. I'm sitting right here. Get a past me. Julian Cork, COO of Landbay. Thank you very much. Thanks, guys. The way I like to moderate panels is I think that everyone's an adult and doesn't have to sit there like a good little boy and wait to be called on. So if any of you agree or passionately disagree with what each other is saying, you don't have to wait and you can stand up. Just, you know, no punches. We'll do that. So as Bindi said, we're talking about alternative finance. You know, alternative finance is one of those industries, you know, everyone in the consumer world knows Kickstarter, crowdfunder, everyone in the UK knows Zopa, peer-to-peer lender. And they were kind of the rebels of the fintech revolution. We're doing this outside of the banks. We're going outside of the banking establishment. So I'm going to talk to you three guys. It has got to the point now in the UK, we now have a law that banks have to refer loans to alternative lenders if they refuse them. A number of banks have announced partnerships or collaboration with alternative finance. Are you guys no longer the cool alternative kids in the corner? What does it feel to now be mainstream, or do you still consider yourself alternative? I'll go down the line.
Liz, I think the move of labeling alternative finance is changing. I completely agree. When you look at something like peer-to-peer lending, you've got to understand that there's a wide range of different underlying asset classes beneath any peer-to-peer lender, all the way through from unsecured consumer, SME lending, secured property lending, and those asset classes are exactly the same things that banks are providing. What peer-to-peer does is simply provide a mechanism that disintermediates a lot of the steps between it. So it is real finance. It's just a different method of providing that and providing returns to institutional and retail investors.
I think that's absolutely right. Certainly in the equity crowdfunding space, people talk a lot about investing in equity crowdfunding. I have absolutely no idea what that means. All equity crowdfunding is a distribution mechanism for several asset classes. In our cases, the equity of early stage businesses. That's something that wasn't traditionally done by banks. It was done by angels and friends and family and a whole bunch of other people. But the reality is we're taking an existing asset class and changing the distribution mechanism. So maybe it is alternative distribution, but the notion that it's some brand new type of finance probably gives us too much credit.
Sorry. I would also add that with the regulation, they've got the same regulator obviously within all these different pieces of alternative finance, and the regulation that's there, and things like the new innovative finance ISA that's going to be launched shortly show that this is just purely a different way of accessing those same asset classes.
So I think that when iwoca was set up in 2011, the alternative part of alternative finance meant that we were just lending to SMEs. I think that the banks weren't lending, and so we were viewed as alternatives simply because we started doing it. Now, we're a balance sheet lender, and so it doesn't really matter where our money comes from. As long as we have the money to lend, we were classed as alternative. I think as we're going forward, and I think as we look to the future, I think that alternative finance really, when you look at it, is doing the same things that all finance has been doing for a long time, which is to provide finance to businesses or finance to individuals, and we're just doing it in a leaner, more efficient way.
I do agree with you. I think a lot of alternative finance grew up in this area where banks weren't really lending to SMEs or to certain individuals. And we've seen last week at Money 2020 in here, Santander has made a big splash about investing in cabbage, and they did it specifically to target SMEs. Do you think sort of banks are really waking up to this market sector that they've either ignored or not really paid attention to over the past few years?
Yeah, so definitely banks are definitely waking up to it because they're looking at their own customers and they're seeing that they're also an iwoca customer. And when they see that, they think, why are we not lending to these people? And so now they're thinking, well, how can we get in on it? Well, they can't build the technology themselves, or if they could, it would probably take them forever to do it. And they have all their own legacy systems to worry about. So they're thinking, okay, who should we do it with? And they're looking for partnerships. And the Cabbage Santander partnership, I think, is a really good example of that, where they're leveraging the technology and they're going to start funding it themselves.
I think one of the features of disruptive innovation in all sectors that often gets overlooked is there's a big difference between the large institutions and the people who work at them. I think that senior people at banks and other major financial institutions have understood for quite some time the importance of the innovative finance sector, the importance of fintech, and the importance of alternative investment. Whether they then have the power and ability and energy and endurance to move the behemoths that are the sort of bureaucratic machines underlying their institutions, I think is yet to be seen. So you can have all the conversations you want with people all the way up to CEO and board level at major banks, and there is a lot of enthusiasm for working together with the space. I think the next few years will be critical in terms of whether they can actually get the wheels spinning to turn that into real action.
It's probably worth also noting just the scale of innovative finance today. For example, peer-to-peer, 100,000 people invested in it, and £3 billion. And you look at the new innovative finance ISA that's coming out. Last year there were 13 million ISAs created, and £79 billion worth put into ISAs. So the scale in which peer-to-peer is in right now is pretty small, but there's certainly upside on market share, certainly in the ISA space.
So I wanted to talk a little bit about regulation and sort of risk awareness. We had a very high-ranking official in the financial industry talk about that he predicts the losses from a crisis in alternative finance will eclipse what happened in 2008. And we recently saw, a few alternative lenders have gotten into trouble calling themselves savings schemes, for example, instead of investment schemes. And we talked a little bit about this panel about the news of Crowdcube and Rebus and, investors claiming they weren't given enough information of the level of risk. Are we going to see more and more of this type of news? Is this just sort of inevitable with the industry maturing? Or is this, as you mentioned, Jeff, the press not understanding what's going on?
Well, look, I think that the key part there is your point about the extent to which products are billed as savings or how they're marketed. The fact is, and representing Seedrs and the equity crowdfunding side of things, we are at the very riskiest end of the market. And the equity of early stage businesses, whether you invest in it through a crowdfunding platform or any other means, is very, very high risk. That is fine so long as you tell people that and make sure they understand it. And I don't believe that so long as any of us, whether it's us or Crowdcube or any of the other platforms, are honest and upfront about the fact that this is a high-risk space, that there's likely to be a crisis. I always like to point out that in 400 years of capital markets, no significant crisis has ever been caused by high-risk instruments that were billed as high-risk. The only times you tend to have financial crises are when you have a high-risk instrument that people thought was low risk. So I think that when you're being very transparent about the risk profile, you don't run a problem. I think where you get into potentially difficult territory is when things are being called savings, when things are being called safe, and there isn't the sort of facts to back that up.
I think it also goes to the point I raised earlier around the underlying asset classes as well. These are asset classes that have been lent to throughout the financial crisis, before the financial crisis, through the financial crisis, after the financial crisis, and it's about the quality of the origination and the quality of the underwriting. One of the things, Landbay chose buy-to-let mortgages that have gone extremely well, and we chose to take on board a underwriting team that have had that experience through the financial crisis and been successful, so that we could make sure that the quality of the assets that we originated is up there.
So I think that Emily Reed, in one of the panels earlier, she mentioned that there are kind of two camps of people, those who are bothered by the rules, the regulatory rules, and those who just want to get on with business and who want to actually do things. I'm in the latter camp of those things, so I'm not massively concerned with regulation, but where I think it's extremely powerful is that it needs to be transparent. And it needs to be something that's easily understood, and it needs to be something that your average Joe, not the people who are standing here in this room, can understand. And I think that if those things are made clear, as Jeff says, and that people know what they're doing, that there is no risk, really, because people understand what those risks are.
Are you sure they do? Because I'm going to play a little bit of devil's advocate. When the alternative lenders market started maturing, it was we're not the evil banks with peers. It's you're getting from the crowd, your peer-to-peer lender. Do you think that sort of feeds into the idea that this is a nicer, less risky space in a strange way?
I think transparency is the key to the question there. And one of the things that the Peer-to-Peer Finance Association have done is really push to have utmost transparency of the loan books that are out there, the rates which we're lending out at, so that it's absolutely crystal clear to people investing on our platforms exactly what risk we see for those loans. And so you can be clear about the margins we're taking and the risk that we see and the risk that you're investing through. Now, clearly, you've got to have risk to have returns, and so we need to not shy away from that, and that's exactly what we're doing with any lending. But by having that full transparency on the rates in which you're putting out the loans, you can really make people understand the risks they're taking on.
So why don't we move the conversation a little bit over to who I work with on a day-to-day basis at Startup Bootcamp, entrepreneurs. So we saw when Startup Bootcamp FinTech started, we saw a lot of payment startups. And then the year after, there was a lot of lending. Last year, we saw asset management. What advice would the three of you give to entrepreneurs looking to break into this space based on your own personal experience?
Okay, I'll go first. I think you've got to think about the long term, right? It's very easy to get overexcited and get ahead of yourself with things, and you've got to pay attention to the detail, think about the long term. Certainly in a lending business like Landbay, it's all about the quality of the origination and being very clear about exactly the constructs in which you're doing that with.
I think one piece of advice I would give is around fundraising strategies. At this point, Seedrs has raised 15 million pounds for ourselves. Our last round was heavily oversubscribed, but it becomes very easy to forget that we really struggled to raise money in early days. And part of the reason we struggled is I think we were talking to a lot of the wrong people. We were going to tech people rather than fin people. And I think we found that a lot of people whose experience is investing in primarily non-financial technologies have a huge amount of trouble understanding and pricing and wrapping their heads around financial technologies. When we finally sort of shifted gears and started talking to people in the city, started talking to first angels and now institutions like Augmentum and Woodford that are specialists in and understand financial services, I think we found much better and more supportive investors. So my advice to anybody starting out today is, fintech's a little bit of a Marmite thing. There are a lot of investors out there who don't love it, others who really do love it. Go after the ones who do.
Yeah, so my advice, which is kind of age-old and very boring advice, would be to solve a real problem. And when iwoca was set up, it was set up to solve SME lending. The banks were not doing it, and we started from day one, and we started doing it. 2 customers who couldn't get any finance from the banks. On top of that, we focused on what our core IP really needed to be, which was credit assessment. So we're a lending business, and we use and we leverage technology in order to make good credit decisions. That's still where we're focused today. That's where we'll be focused in 5 years' time. And all the sorts of periphery and the things you need around that are less important. So just really focus on what your core IP is going to be.
I wonder maybe if we can go into a little bit of challenges, personal stories that each of you faced growing your businesses as entrepreneurs.
So I'll go first on this because I've got... I don't want to complain, but the challenges, I'm sure there's many entrepreneurs in this room, but the challenges really are the mundane things. There's the challenges like getting finance, like Jeff says, which are not really mundane. They're extremely strategic. But then there's just all of the mundane things. What VoIP phone system should I use? How do I hire the right people? How many days holiday should I have so that I can target the right talent? Like these sorts of things, which you don't even think about when you're at the beginnings of a company. As soon as you hit the growth phase and, iwoca is now 112 people, these things become extremely, extremely important. And even though they are mundane, I would say don't forget about them.
I certainly agree with the mundane ones, and Lord knows we've made enough mistakes on some of the smallest things over time. But I think there's some bigger ones as well. Nature of business we're in is I think about fundraising a lot. The other thing is about timescales, particularly in fintech. It's very hard when friends and colleagues are building out a game or some form of app or something where they're iterating every week and they're doing 3 releases a day and everything is moving so incredibly fast that they got week-on-week traction. Finance tends to move a little slower, and I've written a little bit about the fact that we kept trying to measure month-on-month growth, and it was a nightmare because like one month we'd be up 200% and we'd be jumping up and down and think we were gods, and then the next month we'd be down 50% from there and we would be miserable. But the reality is it was just the wrong cadence for our business. I mean, we actually operate kind of on 6-month cycles, quarterly if you're at a stretch, and learning to be a little bit patient and learning to understand that things take a little more time to move in the financial services world, and that's not necessarily a bad thing. That I think was a challenge that took us a long time to learn.
And from my perspective, it's all about having the right team. I moved from the last 20 years working in big banks and with enormous teams, and now I'm working in a company with 20 people, and you spend an awful lot of time with them. And it's really, really important to have the right sort of people who will roll their sleeves up and get stuff done.
Yeah, I just add one thing to what Jeff was saying about, it's particularly relevant actually, it's a very, very good point about fintech and about the scale at which things can move and how quickly things move, and especially for a lending business where we do iterations on our scorecards every single day, but those iterations are not necessarily deployed and they don't necessarily go live because it's too much of a risk to just make it live and have a go and then see what happens. These are real businesses, it's real money, and you need to be very, very confident of what you're doing.
So we have 4 minutes left, so you guys are going to get 2 minutes each for that inevitable future question. So where is this industry going? What's going to be innovative? Where will it be in the next few years?
So I do think back to the theme you originally started with, Liz, the gap between finance and alternative finance is getting closer and closer together. I personally see within the peer-to-peer industry the advent of full FCA authorization for a number of the different firms, and the subsequent launch of innovative finance ISAs is going to mean that there's going to be a greater consumer uptake of peer-to-peer lending. Right now, for context, that 100,000 people is, 0.5% of the addressable population, i.e. a fifth of the innovate curve of adoption. So there's plenty of upside there.
I mean, I think what we'll see, I agree with Julian on all of that, and just maybe even a little bit more broadly, I think we're going to see pretty much every form of finance that doesn't inherently require a big brick and mortar kind of bureaucratic institution will begin to move into platforms that sort of look like ours. Now, those platforms might have the name Lloyd's or Santander on them. I mean, it's not to say that this is all the preserve of outsiders, but I think that the move toward lean, specialized digital platforms without all the overhead that comes from the traditional financial services industry, is absolutely the way of the future. And then you will have a rump of activities that really do require a little bit of old-fashioned manual intermediation and intervention. And what we know is the banks and large financial institutions today will continue to serve those needs, just probably in a much smaller way.
I've kind of drawn the short straw going last with this.
2 minutes all to yourself.
Okay, great. So I'll just slow down slightly. What I would say is that the banks traditionally, and I always refer to the banks like they're some big thing, but they've done everything. They do personal lending, commercial lending, mortgages, car leasing, everything. And I think what's happened is companies have popped up and they're now modular. So if you focus on, a very specific segment, so for example, with iwoca, it's SME lending. We've decided to do SME lending extremely, extremely well, to the best of our ability. All of our resources every single day go into doing SME lending. And I think that that's happening with lots of other startups as well. So other startups may be focusing on payments or money remittance. And all of these kind of modular plays of just focusing on one thing and being able to specialize and do it extremely well is becoming an obvious and attractive target for the banks. And so that's why, we mentioned it earlier with these tie-ups between the banks. They're seeing, this person is doing money remittance extremely well. Why don't we just go and buy them, or why don't we just use them? And I think that where it's going will be white label. I think that in 5 years' time, all of these companies in the room will be doing what they're doing, but they'll be offering it as a white label service, probably via an API and probably via something that's extremely easy to integrate with. So if you're a company that has customers and you decide you want to be able to offer finance, that's fine. There's an API for that. Just send us the data we need and we'll return you a decision, and you can own the relationship with the customer and you can own all the ongoing servicing of it, but we will provide the credit decision. So I think that's where it's going with the modular, kind of modular place.
So just building on your modular theme, I think, as well as banks partnering with various different modular fintech capabilities, it can be across a wide range, and there will be more and more partnerships across a larger group than just banks. And Landbay was recently invested in by Zoopla, and there are lots of interesting things that could be done outside of just a bank partnership.
Lovely. Well, we have out of time just now. Excellent. I love a panel that ends. Gentlemen, thank you very much. The three of you, thank you very much.
Thank you.